Good morning. Welcome to Stock Market Today. It's Friday, November 30th, 2018, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can follow me on Twitter. I'm at Dan_Russo_CMT. I'm also over on StockTwits under the same handle. And Stock Market Today, brought to you today and every day by Chaikin Analytics in conjunction with StockCharts.com and StockCharts TV. And you can sign up to receive a free email, follow along with this show, as well as receive stock ideas. Head over to ChaikinAnalytics.com/today. So U.S. equities were mostly lower in Thursday's trading, giving back some of the gains after a three-day rally. Technology, financials, and consumer discretionary lagged the overall market. Energy and materials led. Treasuries were little changed to a bit stronger. The dollar was weaker against the yen and euro. Gold finished flat while WTI crude settled up 2.3%. Breath on the New York Stock Exchange was negative 1.1 to 1. Breath on the NASDAQ, negative 1.2 to 1. And as we get to the desk this morning, futures are down 50 basis points, trading near the worst levels of the morning. Asian markets were mostly higher overnight, and China outperformed. European markets are on the defensive, though, this morning. Treasuries are stronger with the 10-year yield trading near 3%. The dollar is stronger versus the euro and sterling, but flat against the yen. Gold down 20 basis points in WTI crude, giving some back down about 1.5%. So here's the chart of the S&P 500. Three-day rally stalls out. What's interesting to me is we kind of climbed to within 8 S&P points of that 200-day moving average and then failed. I think the 200-day moving average is the next test for this market as it tries to take advantage of this positive divergence that we've been highlighting that's coinciding with bullish Chaikin money flow. Support is near the Wednesday gap at about 26.90, and then below that, near the kind of opening and closing lows from October and then Thanksgiving week. That takes you down to about 26.30. That RSI does remain in bearish ranges despite this positive divergence, and Chaikin money flow stays bullish, which is important. I think that that those are positive signs at the indicator level that would be confirmed first with a break of the 200-day moving average and then more decisively with a break of that 28.15 level to the upside. So it remains to be seen. I do think the next test, as I said, is the 200-day moving average. We'll be watching it closely, but futures are trading lower this morning, and we do have that G20 meeting over the weekend where the U.S. and China are going to talk about potential trade reconciliations, or at least that's what the market is hoping for. If you're bullish, we'll have to see what happens. Right now, I think the 200-day is the next test, though. Your market in a minute, if you're following along in the email at home, or if you're a Chaikin Analytics subscriber and you have my note. The 5 kind of key points that I'm talking about today. Stocks pause after a 3-day rally. Oil moves higher on a possible production cuts. We'll talk about why I think that's important. Real estate outperforming as yields fall. Remember, I said yields kind of testing that 3% level again this morning. Semiconductors are trying to base relative to the market. And you know that that's a very important metric to me. And futures do point to a lower open here this morning. If we look at the power bars for the major markets, the Dow, 6 bulls to 4 bears. The S&P 500 still just barely holding on to that bullish skew. 78 bullish or very bullish stocks, 77 bearish or very bearish stocks. NASDAQ trying to get back to even, 15 bulls to 17 bears. And small caps gradually improving. 214 bullish or very bullish stocks, 461 bearish or very bearish stocks. No real trend yesterday. Dow a slight outperformer, but everything else relatively in line. Bonds upticked, weighing on yields. According to the Chaikin Power Bar, small cap stocks are more bearish than large cap stocks, and the major indexes are mixed. Now, your stock of the day, again, if you're following along in that email at home, stock of the day that we generate for you, it's auto-generated based on our proprietary Chaikin Power Gauge rating. It's T-Mobile from the Telecommunications Services Industry Group. T-Mobile down in line with the market and the broader tech sector yesterday, down 35 basis points to close at 68.68. That power gauge rating for T-Mobile is very bullish due to very strong earnings performance, very strong price volume activity, and very positive expert activity. Financial metrics are poor, but when we roll everything up, the 20 factors that make up, that fall into these 4 main categories, we come out with a very bullish rating. And what do we have? A very bullish stock with a strong trend in a strong industry group, fishing in the right pond. Here's the rating at the bottom of the screen. The ribbon tells us where it is and has been, and the market and model are in agreement. Notice the stock's been outperforming really since early August. The intensity of the outperformance is improving. Market and model are in agreement. Dynamic duo are in gear. Stock is rounding out of an oversold position, but shaking money flow as the stock trades here near the highs. I don't like to see shaking money flow this bearish. We check kind of 5 out of the 6 boxes that we talk about when we're looking at potential long ideas. I think that if you're going to take a weight of the evidence approach, you can be long T-Mobile, but I think you want to tighten up your stops. I think you really want to have a predefined level that you are going to sell the stock. If it breaks down, this kind of 65 to 66 level looks really important. And the reason that I like having a tighter stop than normal is because of this money flow. This is really giving me pause. Notice what happened back here. Money flow, stock was trading near a high. Money flow was weak. Stock traded off. Tried to rally back. Money flow was weak. Stock traded off. Now we've rallied with weak money flow. I'm afraid of that same scenario. So I think the way to look at this is either number one of, you can take a pass on it, see if it trades down to $64, or you can buy it here because we're checking 5 out of the 6 boxes, but I think your stop needs to be a bit tighter. A lot of different ways to skin the cat. Additionally, you can look at call options where you can predefine your risk, but take part in the upside should the stock break through $70. A lot of different ways to look at it. I want everybody to kind of think about different strategies and ways to implement these ideas. I walk through a few of them, but T-Mobile does look interesting. I just think you need to do it in a risk-defined way. Our sector tracker, looking at the movement of the major sectors over the last 5 days. Healthcare has been the horse we've been riding. We've loved that sector for a while. Moves back to the top of the list. Discretionary moving up a bit, and I think that that's important for the market, as is tech and comms. Bottom of the list, you can kind of see real estate, utilities, giving some back on a relative basis, but still up over the past 5 days. And I think as yields continue to fall, we're going to see those stocks continue to outperform. Energy just still being weighed down by oil, as well as materials just kind of being held back by the commodity sector or commodity complex in general. Our industry in focus today is insurance services, and this is one that we've liked. We've kind of been lukewarm on financials as a sector, but within the financial sector, we have liked the insurance industry. And over the past 6 months, it has outperformed the S&P 500 by about 50 basis points, but the power bar ratio, which measures future potential, is very strong. It's currently ranked the number 1 subsector of the 21 that we look at. And you can see why. 17 bullish or very bullish stocks, 2 bearish or very bearish stocks, and some of the indicative names there: Genworth Financial, GNW, Everest Re, RE, and Reinsurance Group, RGA, all have very bullish Chaikin power gauge ratings. Let's take a look at Genworth here. It was down yesterday, down 1.26%, so an underperformer. But we have a very bullish stock with a strong trend, strong industry group, fishing in the right pond. Ribbon at the bottom of the screen shows us that power gauge rating. You can see that the market and model are in agreement. Started outperforming towards the end of October, and the intensity of that outperformance has been increasing. Stock is currently oversold and kind of rounding out of that oversold condition. And look at money flow going bullish here. Stock trading up here near 52-week highs. I think there's a couple of ways that you can look at this one. You can play it for a breakout through $5. Or you can wait for a pullback if that's how you like to do it. I like playing breakouts, or you can buy the stock right here with a stop, however you manage risk. I will just kind of call out, however, that this is a sub $5 stock. There's a lot of different ways. Some people like to look at these lower price stocks. I think it's a good example of the process, though. That's why I'm singling it out here today. I like stocks that are trading near 52-week highs when they become oversold with bullish money flow, very bullish rating, outperforming the market. I think Genworth does look interesting if you look at lower price stocks. Take a look at GNW. Trending now, yesterday's S&P 500 movers. On the leading side of the board, Dollar Tree, market like what they heard from their earnings. Nielsen, some chatter about a fund joining the potential bidding process for Nielsen sends that stock up 4%. Concho up 3%. No real news there. Same with Activision, Blizzard, ATVI. I didn't see anything that jumped out at me to send that stock higher by 3%. However, Boeing was added to a best ideas list at a sell-side research shop that sent that stock higher by 2.72%. On the loser side of the board, DGX down nearly 10%, 9.28%, as they lowered guidance. WDC, Western Digital, still seeing fallout from their CFO leaving. Twitter, a lot of chatter on why Twitter was weak yesterday. I didn't see much to point to other than there was an article in Politico highlighting the fact that Fox and Fox News have not been active on Twitter since November 8th. I don't know if that's the reason for the stock to be down, but as I was looking for potential data points, that was what showed up. Wynn down 4%, giving back some of their recent gains. No real news there. Same with JW Nordstrom, JWN. That stock's been weak since reporting earnings, down 4%. Yesterday, a lot of those retailers that had rallied are coming under pressure. So now, what are we talking about in our note today? Oil rallies on possible production cuts. This is interesting to me. Obviously, oil's been under a lot of pressure. We've been highlighting this 64 level, and we said if that breaks, to kind of watch out. And that's exactly what's played out. 50-day moving average crosses below the 200-day, both of which are downward sloping. Still really oversold here based on the RSI. And what's interesting is that oversold level is as the stock, as oil comes into some support down around the $50-51 level. Some news yesterday that Russia might join OPEC with production cuts. That sent oil higher by that 2.3%. But what's interesting to me is at the bottom of the screen, look at energy, XLE relative to the SPY, no longer breaking down, hitting support and showing some signs of stabilization on a relative basis. A lot of times the stocks in the commodity complex, the stocks that reflect what's going on in commodities, tend to bottom and turn before the commodity does. So this support on a relative basis could be important. We're keeping an eye on it, especially with oil as oversold as it has become. Semiconductor is another one that we're looking at. You know that this is an important group for me. I always look at the semis relative to the broader market to get a gauge on the potential for the direction of the market. Here's SMH relative to the SPY. It's a chart you all should know well because we've been showing it and highlighting the breakdown first through the 200-day moving average and then through these key support levels. We were talking about how that could have bearish implications for the market in general. That thesis is largely played out. Now, what's interesting to me is while we're still below this declining 200-day moving average, we've now hit support, and the relative relationship between semis and the market has actually shown some signs of stabilization at this support level, and now we're starting to see positive divergences in the RSI of this ratio. Now, towards the tail end of the earnings cycle, we got negative earnings reports from NVIDIA, negative earnings reports from AMAT. If semis were going to crack further, those could have been catalysts for it to do so, and they did not. I'm not saying we're out of the woods yet, but I'm saying is it's encouraging that semis are no longer breaking down, especially when the news is bad in the group. Take a look at semis. They kind of let us lower. Notice how they topped out last November and then went sideways long before the market's top in January and then ultimate top in September. So take a look at semis. We watch it closely. We'll keep you posted if there's any changes there. And here's that rally in real estate. Here's the XLRE moving towards 52-week highs as yields roll over. And look at the RSI shifting into bullish ranges. I know it's not the most exciting group in the market right now, but what's exciting to me is trying to beat the market. And our process is to focus on the sectors and industry groups that are outperforming and then highlighting the strongest names within those groups as potential bullish ideas because we think that's your best chance at beating the market. So with real estate trading near 52-week highs and outperforming, we highlight Store Capital. STOR has a bullish rating, strong trend, strong industry group, outperforming the market while on that bullish rating. So market and model in agreement. Stock is oversold with bullish money flow, riding that rising long-term trend line. Store Capital, STOR, trading at 29.74, looks compelling as a long idea. So that's it. Sign up for the email, chaikinanalytics.com/today. Follow along with this show and get daily stock ideas for free. And if you like what you're hearing, help us spread the word. Have a great weekend, everyone. See you here on Monday.